right, we're here with Leo Addimando of the Alterra Property Group. So Leo, first question, you've purchased multiple billions of real estate and have placed over $1 billion in equity capital. When you started Alterra, did you expect to get this big when you started?
Well, I don't think you ever expect to grow to this level. I think, look, it was started 18 years ago. A little bit of background. My uncle was in the real estate business in Philadelphia since the 1970s. I grew up, watching him develop real estate, mainly adaptive reuse, mainly in Philadelphia, but he also did some stuff in New York. And it just, it always felt like a really cool process of creative destruction, particularly the adaptive reuse where, you're eliminating a particular use. He did a lot of churches and religious buildings and really heavy industrial buildings into, I would call them utilitarian lofts, which, nowadays are kind of really cool upscale condos as they've been kind of redeveloped the second and third time.
Creative destruction. I like that term.
Yeah.
Yeah, it's, you're not really destroying. In fact, it's a little bit of a misnomer because you're actually preventing the destruction or demolition of a building and you're breathing new life into it. But in doing so, there is a portion where you're out with the old and in with the new, mainly inside the building. Mm-hmm. So it started in 2005, really as an adaptive reuse development company in Philadelphia. It has evolved since then. It was not originally called Alterra. It was called 806 Capital. 806 was my senior year college street address. So nice. I had different partners. We renamed it Alterra as we kind of reconstituted the partnership January 1st, 2012. So we're now in I guess we just closed 11 years. We're now in our 12th year, as Alterra. The name Alterra, you didn't ask a question, but I'll tell you because it's an interesting story.
I was coming, so I appreciate it.
No, I was thinking it.
The name means nothing. A lot of folks are like, oh, that's a cool Latin word. It doesn't mean anything at all, actually. I used to try to tell people it meant like alternative uses for buildings and ground, but it's not true. It doesn't mean anything. There are a lot of Alterras. If you go on uspto.gov and you look at a trademark search for Alterra, there's hundreds of Alterras. The particular one where we were exposed to the name was called Alterra Healthcare. It was a pretty prolific developer of assisted living facilities. Eventually went belly up in kind of the mid-2000s. We ended up buying some of their assets from an insurance company. Mm-hmm. And at that time, we thought it was pretty cool, the name. I just kind of decided that if the name ever became available, because at that time it was on a trademark, we would grab it. So, we have a trademark for, I think, real estate investment, development, and management. Everything we do is under Alterra, whether it's, the property management locally, the development locally, or the outdoor storage platform, which is more of a national platform. It all falls under the Alterra umbrella. And
so that's interesting. Am I breaking your guys' trademark with my company's called Axe Holdings, but we have Axe Property Group. And then our LLCs from there are APG2, APG3. And I've had a lot of people be like, APG, you're Alterra. I've heard of you guys. Sometimes I just let it go. But
no, we have no legal trademark or any sort of right to own APG. Although our property management group is known as APG Living.
Yeah,
we occasionally use APG in some of our entity level LLC, beginning, but generally it's Alterra and then the property address, partners.
So you literally just saw the name, liked it, and decided that you'd scoop it up when it became available.
Yeah, and actually, there's a funny story. We didn't even scoop it up first. A residential real estate broker in Humboldt County, California, grabbed it and filed a pretty blanket real estate trademark. And we actually we filed a petition with the Patent Trademark Office to say, the person is selling residential homes in a very small part of the country. The trademark is too expansive, so we basically broke it off. There's also a bank in Wisconsin that has some rights to the trademark for financial services. So I think we are investment development and management within real estate. So it's pretty narrow.
Within real estate, within this market, right?
No, it's a national trademark.
So Alterra in California, are they just out of it now?
He never even used the name, really.
Oh, really?
Yeah, the closest thing that maybe treads on our trademark is Alterra Mountain Company. They're a roll-up of a bunch of ski mountains, like the Icon Pass is their pass. They may or may not be, infringing on our trademark, but we're not in the ski business, so it's we're not it's not a priority. But there are a couple of companies locally that tried to use Alterra with one R, and we've definitely
try to like gain on your traction.
Yeah, we actually got the city. Actually, I got a really angry phone call from somebody within L&I saying, you guys are doing this and that, and finally he realized that it wasn't us, but the name was close enough where they thought it was us. So it's a good name, but look, ultimately name is only as good as the people, and the product and the performance. So the fact that it's a catchy name, is meaningless if we don't actually, build good projects and manage them properly and do all the things that you guys knowing in real estate is the hard work, right?
Yeah, you give the name meaning for sure.
Try to.
This episode is sponsored by MSC. MSC is the premier commercial real estate brokerage serving Pennsylvania, New Jersey, and Delaware, focusing on retail, restaurant, and hospitality transactions. Whether you're a seasoned developer or owner looking to fill a ground floor vacancy or an established tenant seeking to grow your presence in the region, MSC is your one-stop shop for retail brokerage services. Visit MSC at hellomsc.com. That's www.hellomsc.com, or contact Jacob Cooper at 215-883-7402 to discuss your commercial real estate needs. Yeah. So when you first started, like, what was that core business then?
First deal was in Callow Hill. We bought an old flavor factory called Otten's Flavors at 1234 Hamilton Street, and converted it into 17 for sale loft apartments, loft condos. That project took 9 years from beginning to end. It was supposed to take a couple of years, but the GFC happened, and we had some zoning and some construction issues, and we had a little scuffle with our lender along the way. But we fell out of the tree, hit every branch on the way down, and managed to land on our feet like a cat. We did a bunch of other deals, obviously, in that 9-year period, but it was very formative. That first development deal and all the everything that could have kind of gone right and wrong happened in one project. So definitely a lot of
learn a lot
of learnings there.
Yeah, it sort of hardened you on your first one.
It wasn't an easy one.
Yeah. But it's still a pretty sizable project. Like, you started out, your first project was, you said, 17-unit condo development.
Yeah. So, I was fortunate. I had some capital with me when I came to Philadelphia. I had an uncle who was in the business. He helped tee up my first project. I brought all the capital. I signed for the loan, but ultimately I used, a contractor he knew, an architect he knew, and a lender he knew. So that made it a little easier to kind of, skip the row home renovation, which is usually the first step, right? You kind of flip a row home, and maybe you do 4 or 5, and maybe you keep those, and then you use that money to do more.
Do a triplex.
Right.
And,
So we just went right to, I think it was maybe a $10 million project day one, which, that was the sort of the jump start, right? And then from there we did a series of projects that were, increasingly larger. We did some smaller ones along the way too. We did actually a couple of row home, like we buy a townhome on Spruce Street and chop it up into 6 or 7 apartments. We did a lot of that too. Not a lot. We did maybe half a dozen of those along the way. But yeah, we definitely skipped, like the, like kindergarten, first, second grade, where we kind of went right into, middle elementary school before, from the beginning. And that, in retrospect, was positive in some ways, but also there were things that we would have learned, in doing smaller projects that might have made the first few a little smoother, which we just didn't learn. But, we learned on the job.
Yeah. I mean, the learning lesson would maybe be 10 grand instead of 100 grand. But would you do it a different way if you were going to restart?
That's a good question. I think the real question is, would I have jumped into real estate, with zero experience as a principal, rather than going and working under somebody else and kind of learning the ropes a little bit? For me personally, probably no. But I see a lot of value in doing that. But I think, part of it has to do with the person. I don't do particularly well with authority and with having a boss. So for me, it was more like I'm going to succeed or fail, on my own. So why not just get on with it now? I graduated from business school. I came right here and I just jumped into being a developer. But, I had an uncle and a mentor who definitely, at least in the first project, was very helpful in sort of saying, you shouldn't do these 5 things, right? So that was helpful. was kind of a short-lived, sort of mentorship and on-the-job training on that first project.
I was going to ask because, you mentioned a couple things there. One thing that stuck out to me is like control. It looks like on your website, you guys, handle a lot of the acquisition, entitlement, project and construction management, leasing, the list goes on and on. It was the intent to always kind of, you mentioned yourself as what you want to control that whole type of thing or the whole process in general?
Yeah, I think that at various points in time, we've kind of grown what we're able to bring in house. So we've had the opportunity along the way to also bring construction in house, and we've chosen very deliberately not to do that, but instead cultivate relationships with people that we trust. Including Gary from How.
Right.
They do kind of our medium-sized projects. We have another group that does the smaller projects. No, smaller can still be a $25 million project, right?
Yeah.
And then we have a couple of larger general contractors that will do the sort of big projects for us. And that to us has been a good setup, but everything outside of construction we've sort of methodically grown into. So with the first 5 or 6 years, we didn't have any property management. We outsourced that, and then we brought it all in-house. That was a good decision. I think it's really hard to be a multifamily developer, a mixed, especially like a developer for rent, not for sale, and not have your own ability to sort of lease and manage and control that experience for the tenant.
Mm-hmm. Is that timing intentional too? Did you wait until you had a certain amount of units that you could generate income, essentially from the opportunity cost?
Yeah, there was a component of that. We definitely brought it in house once there was enough to sort of support some of the overhead. I think what's tricky is that at different points in time, the minimum effective scale for property management was smaller than it is today, right? I used to think if you had like a couple hundred units, you should bring it in house, but so much more technology is available and frankly should be used in today's apartment management world than 20 years ago or even like 10 or 15 years ago. That technology is expensive, and it's very expensive if you don't have 500 or 1,000 units. We manage a couple thousand units, and I don't think we have scale, but for us it works. Scale nowadays is sort of 5 to 10,000 apartments or more. Where you can buy all the different software, Yardi, Blue Moon, Rent Cafe, RealPage, you name it, right? And get it on a per door amount that makes sense, because they charge you per apartment per month, right? So, yes, we definitely waited till a certain point, and then once we got into it, we decided we have to be good at this, not just do it because we're trying to make a little bit more margin. Do it with purpose, make it a core competency, make it a point of differentiation. I actually think we're the best Class A apartment manager in the city. I would put us up against, Greystar and Bozzuto are the two biggest, on the East Coast and in the whole country. Greystar is the largest apartment management company in the whole country. I know that in the same building we will generate a better experience and a better bottom line NOI. But we're only in one market. We're also in Pittsburgh, where we own one complex. So we're very micro focused on the property management side.
How long do you think it took you guys to kind of become that top tier? Can you kind of talk about that experience of becoming that and making that a core competency?
Sure. I think it's in the last sort of 3 or 4 years, since we brought in, I would say sort of generation 2 management for that business, where we brought in better leadership. We also were able to sort of groom a lot of people who've been part of the business now for 5 or 10 years, and they've gone from assistant managers or leasing associates to regional managers and vice president level positions. So as the company has grown up, I'm 46 years old. I started the business when I was 27, right? As I've grown up, so has the quality of talent here, both because we've brought in better people because we could afford to pay them, but also because the people who've been here, for 5 or 10 years, they're here for that long because they're good at what they do, and because we give them the opportunity to advance. So, it's a whole organizational kind of growth, and maturation process.
Kind of create the ecosystem for people to grow within the company once they get here.
Correct.
Now, when you guys started, how many was there?
So originally it was me and an analyst, His name was Adam Cohen. He runs a investment company now, based in Jersey. He moved away and then he came back. So it was me and him. And then we hired a sort of property manager, operations person. Then we hired a bookkeeper, and there was like 4 of us, right? And then we hired a construction manager, and we hired a couple more, sort of jack of all trade people. When we made the transition from 806 Capital to Alterra, we probably had 15 to 18 employees. And then if you roll forward to when we launched the iOS business, which was in 2016, 17, we had probably 30 employees, and now we're around 90. 60 of them are on the apartment management and development side of the business. Let's say 20 of them are on the industrial outdoor storage iOS side of the business, and 10 of them sort of sit in the middle, like our CFO or director of marketing or VPs of property management, asset management, human resources, construction and development. They're sort of shared services, so they span they're on the platform level, and they sometimes are working on industrial stuff, sometimes are working on apartment, mixed use stuff. So it's an interdisciplinary team of people that, over time, as you get bigger, one of the consequences of growth is that people have to become more specialized, more sort of siloed. So we're going through another organizational growth process now where we're slowly sort of separating the two sides of the business, so that if someone's working in accounting, they're either working on apartments or they're working on industrial, right? Less and less are folks being asked to wear 2 hats because it's inefficient for them to sort of switch their brain from one to the other.
Sure.
And we give them people opportunity to sort of decide, where do they want to be. So it's been good.
So it's an interesting path to expansion then that you guys had. You and correct me if I'm wrong at any point here, but it sounds like you started with multifamily and then you grew that business, and eventually, when it was appropriate, you started taking various pieces of the operations in-house.
Yep.
And then very recently, you pivoted slightly towards industrial to add that to your repertoire. That's not like a really common thing I feel like I see from a lot of people. I'm wondering what were your thoughts on that pivot? What caused you to look into industrial more thoroughly?
I'm going to give you a long answer. It's actually 2 separate questions. So 1, why did you diversify? And then 2, why did you pick this category, industrial outdoor storage?
Right.
We weren't looking for another type of real estate. It just sort of happened in 2016. I got a phone call from a friend of mine that used to run the largest national crane company. It's called Maxim Crane Works. They're known as Amquip locally here. And he had a real estate problem in Boston. They were being evicted from their yard. The local team there, the general manager, couldn't figure out where to move them. There were a lot of dynamics as to why it was a difficult relocation. So he asked me if I could help. We took a lot of effort. We moved them in 2017 to Revere. It's like moving from Philadelphia to Bensalem, or Philadelphia to Essington, because Revere is just north of Logan Airport, and the airport's north of the city rather than south of the city here.
Gotcha.
And so we did a few more of those with him. Did one in Nashville, one in Portland, one in Dallas. And at that point in time, my partner Matt had joined us. He now runs our industrial platform. He came over from another private equity firm, and we looked at it and said, gee, this is an interesting opportunity. It's not just a tenant-specific opportunity. There's a whole category of real estate that is sort of hiding in plain sight. Nobody really understands what it looks like, how it functions, what the tenant requirements are. So we went for it, right? We saw the opportunity and said, this is much more national, scalable, and differentiated than, being maybe a good, but just another developer of apartments and, mixed-use properties in Philadelphia. So the opportunity was sort of serendipitous, but what we did to take the opportunity and grow it into an entire platform, and probably the market leader in the country, and just give you a sense of scale. When we got into outdoor storage, we owned, let's call it $600 million of multifamily, almost all in Philly, a little bit in Pittsburgh. That grew to about $1 billion. It's now about $800 million, give or take. We now own $1.7 billion of outdoor storage. So
That's between here and 2016?
Yeah.
Wow.
So
you said that's like the national leader.
Yeah, I mean, we don't know for sure, but we think it's one of the largest platforms. It's certainly the largest dedicated platform. There are other large real estate investors like Brookfield, Cerberus, Fortress, JP Morgan, Carlisle, that have holdings in outdoor storage. Some of them are with us, in the case of JP Morgan. But we think we're one of the larger, if not the largest portfolio, or series of portfolios. If you kind of put them all together, series of ventures into one large portfolio, and we are the largest that's dedicated on the industrial side to this low density outdoor storage. There are a lot of multifamily managers, and when I say managers, developers of multifamily, and just generally developers of residentially anchored mixed use kind of properties that had good track records, national teams, construction management capabilities, access to institutional capital or their own capital, who actually pivoted and added industrial development and acquisition as a strategy that rode alongside multifamily. MRP, locally in DC. One of the largest spec builders of apartments is Hanover. They're based out of Texas. They built two or three projects locally. They have an industrial division now. I mean, I could go on and give you lots of examples of people who sort of, I call it, jumped on the Me Too train and said, well, we do apartments. Industrial's also hot.
What year was this?
I mean, this is happening right now.
Yeah.
It's happening right now. We didn't jump into industrial outdoor store. First of all, what we do and what they do is very different. We buy low density industrial or develop it, mainly buy it. They're trying to build warehouses, right? Outdoor storage is very different than the warehousing business that you drive up Lehigh Valley. You see millions of square feet of white roofs of, Amazon and Walmart and, rooms to go, you name it, right? We don't do that. We do the support real estate. So the truck parking and the container stacking,
How big is it to even make sense for you guys? What's the average site?
So that's the other thing. We are, it's a little bit of a death by 1,000 paper cuts business. So we bought 190 properties. So do the math, 1.7 billion divided by 190, you're about $8 million, $9 million a deal. So imagine doing that in 30 states, 35 markets across the country. You could buy 10 Amazon warehouses and aggregate the same amount of, dollar volume of real estate. So
administratively, it sounds like
well, look, but remember, we have 2,000 apartments and probably 3,500 tenants in the same Philly and Pittsburgh. There's 60 people involved with that business. We own about 160 some of the 190 that we've purchased still. Okay. And they're in 26 or 7 states today. We have 20 people that work on that business. Right. So most of these are single tenant, triple net lease properties.
So the management of a site is just...
Most of the sites, 3/4 of the sites require very little management per se. It's more asset management than property management. When we buy sites that are multi-tenant, where they're short-term and they're not necessarily triple net leases, part of our strategy is to kind of bring those into a single or maybe 2 tenants at most, triple net lease, setup.
I was here. What's a triple net lease?
So it's NNN triple net. It's net of taxes, insurance, and maintenance. Okay. So it's like a CVS.
So it's like the gross is your net.
Right.
Yeah. Okay, so in our portfolio, we're 93% gross collections to NOI.
Okay.
Right. That 7% is largely concentrated in a handful of assets where the tenant might not pay all the taxes, as taxes go up, or, you've got an old roof, and a lot of times roof and structure and paving are on the landlord. And so the primary improvements to these properties are, whatever, kind of improvements on the ground, whether it's concrete or paving or crushed aggregate where you can kind of roll heavy machines on and not chew up the asphalt, the fencing, the lighting, the roof, maybe heavy electrical service, if, stuff like that. Very different than the apartment business where you're spending $5,000-$10,000 every 5 to 7 years to kind of upgrade your apartments. And the office business, forget about it. You could spend $150 a foot every 7 years, to swap office tenants out. It's a very low CapEx business, and that's really advantageous, in a lot of respects.
So when you're going back now to finding opportunities, are other people just not utilizing the space as much, or people just looking to offload industrial? How are you finding these specific opportunities? First question. Then second, what are you maybe noticing that others aren't?
Well, look, the whole thesis behind the business is a structural, very long-term imbalance between supply and demand. So that's proven to be categorically true. So let's just take take it as a sort of an accepted fact that the demand for outdoor storage will forever outpace the supply for a whole bunch of reasons. Okay. 95% of the ownership is non-institutional. It's owned by a lot of baby boomers who inherited it, or inherited a business that used to operate on it, or created a business that used to operate on it. And at some point in time, they're going to sell the business or have sold the business, and maybe they still own the real estate. Okay?
Interesting.
That's a lot of, and our primary competition, frankly, aside from, a lot of firms that have sort of sprung up over the past few years and said, oh, we can do this too, right, is users. So like Penske, for example. Penske's a huge truck logistics rental company. They like to own their own real estate, but there are places where they can't find something that fits the requirements, in which case they prefer to work with us in a lot of cases. And we have a handful of projects. We're doing one down on Essington Avenue where we're turning an old like really beat up warehouse into their Penske facility locally, where they can service, repair, and dispatch logistics and rental trucks. So
you're not just outdoor storage then. You do a couple different things, right?
No, on the industrial side, it's all outdoor storage.
Okay.
So Penske typically wants a 20,000 square foot building or less on 5 acres. So we define outdoor storage as zoned industrial with the right to use the yard separate from and not ancillary to the building, and under 25% coverage of building to land. So we own a property in Savannah that's 37 acres. It has 480,000 square feet of buildings on it. But that's still well under 25% building coverage to land. A lot of folks would look
Still
at that.
outdoor storage.
It's outdoor storage.
Yeah.
It's a lease to it's called Port Logistics. They're a container servicing firm.
That's one company.
One company leases the whole thing.
Whoa.
Yeah.
So last month, Sam Zell was in a forum, and he said, in his opinion, he thinks we overdid it with industrial. So he said he wouldn't be surprised if in 5 years conversation is around repositioning industrial. Do you think he's just off base, or is that a different type of industrial that you're focused on?
No, he's talking about Class A warehouses for sure. So there are some industrial buildings. We'll use Amazon's kind of generation 3 and 4 super regional facilities as an example that are incredibly specifically built for Amazon. They have
Is that like the ones that they were doing in Southwest?
They tried to do a medium-sized one in Southwest.
And they canceled it, right?
I think so.
Yeah,
I think so. Now these are like 70-foot high buildings that have all kinds of robotics on the inside. So there are some, and also then their local fulfillment centers are very specifically built as well. Okay. Those kinds of buildings, when Amazon leaves them, if they do, will need to be, there'll be some adaptive reuse there. I don't think Sam is right that we've overbuilt warehouses. If you take a 10-year view, we're at, e-commerce is at 16, 17%. It went as high as 25 or 30% during COVID. Now the percentage of retail sales that are online is sub 20%. It's supposed to grow 26% by 2027. That alone requires 1.2 billion square feet of industrial just in the U.S. Okay, how much of that has already been built and will get absorbed over the next 2 or 3 years? There's 500 million square feet of unleased, under construction Class A industrial in the U.S. right now. So will there be a bit of a supply glut in the next 2 years? I think so, but I don't think it's the doomsday scenario that Sam is referring to, with the exception of some very specific type of distribution buildings that are catered to one single user, that being Amazon. I can't even name another company that's been as specific in what they built as Amazon has been.
So it's a really niche, subsection of the market. You're thinking that there's a short-term oversupply.
I think that there's a short-term oversupply of Class A, large warehouses. The U.S. industrial market is around $2.5 trillion in asset value. The stuff we focus on is 10% of that. So a couple hundred million.
Oh, wow.
A couple hundred billion, 250 billion, somewhere in there. And we don't buy warehouses. We do buy properties that have what looks like a warehouse on them, but they're used more for the servicing and repair of vehicles and other heavy capital intensive equipment involved in transportation, logistics, and infrastructure development than they are for goods going from, the U.S. economy is 24 trillion, right? half of it's goods, half of it's services. The good side is effectively something is imported, it gets to a port, or it's manufactured domestically. When it leaves the factory or the port, it makes 3 to 5 stops until it gets to your house or Walmart. Those stops are warehouses. Okay, but that entire ecosystem, that chain of logistics and distribution, also presupposes the existence of companies in the business of logistics, transportation, and infrastructure. Okay, so our tenants are in the business largely of logistics, transportation, and infrastructure. They support the movement of goods, they move the goods around, but they don't warehouse the goods. All right, so that's a big difference.
It's kind of it's like the old adage of like, you know, when everyone went out west for the gold rush, the guys supplying the shovels made the most money. You're sort of just supplying the shovel.
That's right. That's actually a very good analogy.
So now it seems like to me, and correct me if I'm wrong, this is becoming, you know, even larger part of your business than, you know, the stuff you're doing kind of in the local market. Is that fair to say?
Yeah, it's 2/3, it's 70% or more of the business today.
Is that going to continue to grow for you? It sounds like, you know, this has almost been like a hedge against, you know, the multifamily space. Do you can see that as maybe something you'll get out of? And then second part of that is, are you planning on continuing to expand that multifamily within the Philadelphia market?
So we didn't start it as a hedge. We started it, you know, again, we got into serendipitously, and then we realized there was an opportunity, and we really kind of seized that opportunity.
More of an expansion than a hedge.
Yeah, but more of like it's a whole different line of business, really. It
Yeah.
kind of runs under the same platform and has the same name, but it's a whole different business within real estate.
Sure.
We hope to buy, you know, 5 or 10 billion worth of this asset class in the next 3 to 5 years. So it will, because of the volume and the scope, it's a national scope, right? It will be probably forever bigger than the multifamily side of the business. We currently have no intentions of, you know, abandoning multifamily. You know, we actually are either under construction or soon to be under construction in Philly with almost 400 apartments in 3 different locations. And we have a couple more planned to start next year. So we've got a, you know, 2 or 3 year pipeline of interesting mixed use developments in kind of, you know, Fishtown, Center City, you know, South Philadelphia, places we've developed before and are comfortable with sort of our basis with rents, expenses, tenant demand, all that kind of stuff. I do hope that over the next 3 years, once the dust settles from this current, you know, credit crunch and macroeconomic event, whatever it ends up being, I do hope that we'll take the multifamily business outside of Philadelphia and Pittsburgh. I don't know where it's going to go, and we're that's part of what we're trying to figure out this year is kind of charting a new strategic course for the non-industrial side of our business, which is our, you know, original business. But I don't know for a fact right now what that's going to look like in 2 or 3 years. But
So you'd stay in Philly, but okay.
We have a lot of conviction in Philadelphia. Look, I mean, Philadelphia is like the most maligned city in the country, and those who are from here are the most negative in a lot of cases on Philadelphia. I can't say the number of people I know who are local who won't invest locally, and I think it's a shame. You know, the city doesn't boom like places like, you know, Arizona and Florida and the Carolinas, but you're going to see the strength of Philadelphia as this economy turns and we get into a recession here. You're going to see that the solid base of employers in the city are going to carry the day. And we don't boom, we also don't bust. Historically, if you look at, you know, occupancy and rental rate growth across different product types, Philadelphia is pretty steady. We obviously have, you know, an interesting political dynamic here, but it's actually not that different. Everyone in Philadelphia, a lot of folks are very, very parochial and myopic. They're like, oh, we've got, you know, we don't have great leadership. You know, there's too much, you know, expectation of taxation on those who have and redistribution inefficiently through government waste to those who don't have. We have urban blight. We have gun issues. We have safety issues. We have zoning issues, inequality issues. You think it's bad here? Go to San Francisco. Okay?
Yeah.
Chicago has major issues. Okay, DC has issues. Minneapolis has issues. Los Angeles has issues. They're all sort of flavors of the same ice cream. They may be different geographies, and the political setup might be a little bit different, but these issues are not Philadelphia specific. Everything I just named, right, exists in spades in a lot of other places. And we have a lens into that because we buy real estate all over the country. And for as difficult as some people think it is to develop in Philadelphia, There are places where it's much more difficult, actually. There are also places like Fort Worth, Texas, where it's incredibly user-friendly, where you go in and they actually have service level agreements for the turnaround time on permits and reviews, and they give you a form. They say like, our SLA is 3 weeks on this, and when they give you your plan review back, your permit, they tell you like, we beat our deadline by 4 days. Like they get scored on
That's amazing.
right?
If anyone from city council is listening, that might be
Sounds like a great idea.
Yeah, it sounds like a really good SLAs. I like that.
I don't want to get off the case for Philly just yet. I guess I don't want the case for Philly to just end up being like we're the tallest little person. There's obviously a lot of good things happening. I'm curious from your perspective what those really positive things are, because you're not going anywhere. So why?
So the case for Philly. We have tremendous educational and medical institutions, which are great attractors of talent. Retaining that talent, particularly coming out of the educational institutions, has historically been one of our Achilles heels in Philadelphia. But we have great human capital in Philly.
Do you think there's programs now to keep that talent?
I wouldn't say programs. What attracts talent is job opportunities, right? Quality of life. So the quality of life in the Philadelphia area is quite high, but for some of the very urban issues, that were always there, but post COVID, they've just been exacerbated, and they're just they've gotten worse. And it used to be, look, here's how I view like the gun violence problem in the city, right? For as long as I've been alive, there's always been gun violence in Philadelphia in traditionally African American and other minority neighborhoods. Okay, about 10 years ago, some of that violence was spreading into traditionally white neighborhoods, more affluent neighborhoods. Okay, as long as that violence was really minorities on both ends of it, even if it was in non-minority neighborhoods, it was a problem, but it was just still not an epidemic. It wasn't a political, imperative. When you have minorities committing violence against non-minorities in non-minority neighborhoods, all of a sudden people are like, holy cow, we have a gun problem in Philadelphia. We've had a gun problem in Philadelphia for 50 years.
Yeah.
Okay. This is not new. If you look at the homicide rates and the violent crime rates, sure, they've gone up, but they're not materially different today than they were 10 years ago. The zip codes of where they're happening has changed dramatically.
And people are just paying attention. I mean, social media too brings it to right in front of everyone's faces every single day.
It's hard to ignore. There are a lot of things that contribute to it, but if you kind of take a step back and you dispassionately assess like what has actually changed, what's changed is now you can't ignore it if you're living in 19103, because it's happening in 19103. It used to be happening in 19147, 19125, but now it's on your front door. So now you got to deal with it.
Well, we invest in 19143, and some of the areas of the neighborhoods that we invest by statistics are safer than 19103, which is wild to think about.
100%. That's, when we talk to retailers, we were looking to do some interesting mixed-use projects up on American Street, north of Girard. The crime stats there are better than they are in Center City right now.
Yeah.
It's
right?
wild.
Yeah.
So
really wild.
they don't have the density of people, so there's other issues, when retailers assess these things. But so great human capital through the educational institutions, right? And also, great medical complexes that create jobs. We have some good local employers who have, I think done a great job of bringing more employment into Philadelphia. Comcast in particular has really kind of doubled down on having people in Philadelphia, not in New York and California, all places, right? There's a chance that this whole life science thing really does become a core, job engine for Philadelphia. Right now, it's a little bit more talk than it is actual jobs in the city. But I think Philadelphia is going to end up being one of the 5 or 10, kind of hubs of life sciences. It's happening, right?
So I'm sorry not to interrupt, but I just am curious specifically on this point, only because our business strategy is basically pick up the crumbs that fall off the table where the big guys are eating. So we're buying all around University Place 3.0 and U City Square and what's the big one? Schuylkill River or Schuylkill Yards.
Schuylkill Yards, yeah.
So I mean, in your perspective, if it's not there yet, is that just because these development dollars are currently flooding in and these buildings aren't built? Or are you saying like you think a lot of these projects have the potential to not get finished?
I want to preface this by saying that I don't know a lot about the economics of life science real estate development. We purposely have not gone into that space because it's specialized, requires a lot of capital, and there are some pretty big players in the space. So I'm going to speak a little bit out of school. My perception of what's happening right now is that a lot of the exuberance around life science development, and specifically spec building development, was fueled by a biotech boom that was fueled by a lot of very easy to come by venture capital money. That money is gone. Okay. You've seen there's the
Gone in the last 2 weeks?
Gone in the last 8 months.
Okay.
Yeah, the last 2 weeks, now it's physically gone, but the government's going to make it reappear again. But it's gone.
Yeah.
These companies lose money. They lose hundreds of millions and billions of dollars for years, way more than tech startups, believe it or not. So, and it's those tenants that were really fueling the demand side of life science, office development. I don't know how much is being built relative to the actual demand, but I know that I've heard of a lot of biotechs shutting their doors in the past few months, right? Because they run out of cash. They may have great science, great molecules, but getting from a molecule that works on mice to an FDA approved drug for human beings that you can actually get Medicare to pay for, which is like the Holy Grail, is a whole different ballgame. It requires immense amounts of capital.
And during that delta, you're not bringing in money.
Correct.
During that period.
So if there's no venture capital available, then how are you going to pay rent?
Makes sense.
So I'm a little worried about the supply and demand in the short term for life science, office buildings, lab space in Philly and everywhere else, right? But I haven't looked at the actual numbers.
That's fair. I more so had a personal curiosity.
Yep. I do think the things that are being built right now, they will lease up. The Schuylkill Yards building that's going up right now, the University Place 3.0 building, or I don't know if it's 2.0 or 3.0, the one they're building right now.
Yeah.
They'll lease that building up. Yeah. Will they break ground on 4.0 immediately? I don't know. They got to lease 3.0 first, I would think. So I'm cautiously optimistic about the role that life sciences will play, and it's a positive for Philadelphia. And
it sounds like it's a potential Hail Mary, where if it comes through, it's like the Holy Grail, to use your words. Yeah, on a different topic, but your words.
These projects can be tremendously profitable, is my understanding, if you can lease them up.
Yeah.
Okay. Outsized profitable versus other types of real estate where the outcomes are maybe a little less binary in terms of, are you going to be able to lease them and what kind of rental rate are you going to get? Just to go finish your question about what does Phil have in its favor? The proximity, being between New York and Washington, D.C., two of our major, political and financial hubs, and having a lower cost of living, having more affordable housing, more housing affordability, I should say. Those are positives. And by the way, housing affordability in Philadelphia may have gotten worse, but on a relative basis, it's actually gotten better. Okay,
relative to our neighbors.
Correct.
Right.
So that's positive.
Yeah.
We have great infrastructure. The airport is actually, it's a really good airport, and it's very close to the city. Right. We have access to rail. All the infrastructure in Philadelphia. We have a port here, which is growing significantly. Yeah. Those things are all in favor of Philadelphia. The only thing that's holding Philadelphia back is a lot of the unfortunate, political, dynamics.
Yeah, I was going to say, so let's switch gears now. I'll be the bad cop. Make the case against Philadelphia. And then the second part of that, I do want to ask, would you ever leave the Philadelphia market?
Would I ever leave the Philadelphia market? Probably not, because I live here, and I'm very much like a proponent of Philadelphia. I'm a hometowner, if you will. I lived in Boston for a couple of years, and I didn't like Boston for all the reasons that I like Philadelphia. Just the only difference is I'm not from Boston, right? Yeah. So all the stuff that bugged me about Boston, if it were in Philly, I'd be like, oh, it's just normal, right?
They're two similar cities, but the things that are similar butt heads.
Yeah, Boston doesn't have the kind of blight and poverty and politics of race we have in Philadelphia. It's
it's a lot cleaner. It's the first thing you notice when you go there.
It is cleaner. It's also a lot smaller. Philadelphia has a very large land mass.
Yeah.
Boston, much less. Boston has under 1 million people. Okay, it's like 700,000 people in Boston proper, and a lot of the kind of lower income parts of Boston are not in Boston. They're in Dorchester. They're outside the city, so they're actually somebody else's kind of municipal problem, right? So Boston is a bit of a unicorn, but So the case against Philadelphia is, unpredictable political backdrop, high tax, high sort of like tax burden on business for sure. Although relatively low tax burden, believe it or not, on residential. And property taxes are actually relatively low. Property taxes in Chicago are 3% plus or minus of value. We're at 1.4% in Philly. People are like, oh, we have huge property taxes here. Now on the business side, the UNO tax effectively acts like another property tax, and so basically it doubles the effective property tax, right?
So isn't that like the wage tax as well, as far as running
On
a
top,
business? It's
so
just
then
like,
you add the wage tax,
Yeah.
the gross profits tax, the net profits tax. You add all those up, and like it's expensive to do business in the city of Philadelphia.
yeah,
Right.
but to live here, it's not as expensive,
Correct.
Yeah.
It's not as expensive,
relative.
but relative to the wages, right, and the job opportunities, housing is getting less affordable for the middle class in the city of Philadelphia. I worry about that.
Yeah.
When municipal workers and firefighters and police officers can't afford to live in the city, I think they just relaxed it where now you can be a police officer and not live in the city, because they couldn't find candidates.
That's sort of, where do you go?
Where do you go?
Yeah.
Right. So, and the case, there's also like the lack of population and job growth is probably from a macroeconomic and demographic perspective, probably the biggest knock against the city.
I don't want to spend too much time on it, but you mentioned the political environment. Do you care to have any thoughts on the upcoming mayoral race?
I hope that whoever wins, and there are lots of great candidates, and I would say there are 8 people qualified to be mayor, which is great. I just hope that whoever wins the race has a constructive working relationship with city council, and it's not like one trying to upstage the other. And it's been disheartening to see, the sort of disengagement of our current mayor and administration. So just having somebody who's kind of fresh and wants to get things done,
Wants to be in the job.
will be great.
Yeah.
Yeah.
I think that our current mayor has loves the city. I don't doubt that. I think he's given it his all, but COVID was a real kick in the face, and I think he never recovered. Kind of his spirit never recovered from it. That plus, the kind of like not having a great relationship with city council, even though he was in city council for 17 years, I think, has just kind of ground progress to a halt, and that's a shame.
Yeah.
Yeah.
That's a shame.
All right. Well, I appreciate that. You alluded earlier to a potential downturn. Like, now is a good time to invest in Philly, hypothetically, because this is why we invest. We don't get hit as hard for a downturn. So I'm just curious, what are your predictions for the real estate market over the next, say, 12 to 24 months?
I think you're going to see property values go down 5-10%, maybe 15%. I think that multifamily rents will be very flat. In fact, they'll maybe be net negative in end of 23, 24 if you count in concessions, as a lot of supply gets, comes online. But I believe that'll all get absorbed, and by 25 we'll be back in sort of appreciation, both on value and on rent mode. I think we're going to fare a lot better than places like San Francisco.
Yeah.
And even places like certain Sunbelt cities have seen 10 to 20% rent growth for 2 or 3 years. Those rents have to come back.
Yeah.
It's just they're not sustainable.
Oh, you think the rent market is actually even going to
It's
correct downwards?
It's happening.
Yeah.
It's happening in certain Florida markets, Carolinas, San Diego, Seattle, Arizona, Scottsdale, Phoenix. They're seeing
Las Vegas too.
Yeah. Rents are definitely going down in those markets.
So you might have some people that, they have a balloon coming up or an arm, and rents are dropping, and they could be in rough shape.
Well, it depends on their leverage rate, but yeah. I think you'll see more of that. Well, there's 2 things. One is rate driven, right? So at any leverage rate, if you're replacing 3% money with 8% money, you could have a problem if you're levered too much. If you add on top of that your NOI is going down, that could
Valuation's less, even
kind of
at
a
the same
perfect storm.
leverage.
So
Was that now switching to like a deal specific, talking about, you recently pulled out of acquisition of 17th and Market. Was
Josh,
that
real quick before we go there, I got one more.
Yeah,
like
sure.
super quick. You're talking about a pullback in values you're expecting on the residential side. My devil's advocate question is just, where would that come from, being that supply is so low?
I'm talking about the for rent market.
Okay, so
so
just for rent.
For rent. I don't
for
have a
sale, you're not really in that market, so you don't have much of a
Yeah, I mean, look, the for rent market is different than the for sale market in that, it doesn't trade every day like homes and condos do, right? And, your leases are yearly, so that helps a little bit. The for sale market, I think, for sale market in Philadelphia is already slowed, okay? And more days on the market, more price reductions. Is it going to go down 20%? I don't think so, but I think we've seen peak value for this cycle for home values in the city. I think you're going to see them go down a little bit, but I don't predict, an 08 style 30%, kind of drop. We didn't drop 30% in Philadelphia anyway, but I don't.
It was like 22 or something.
A huge drop.
Yeah.
On the rent side, when rents are flat and expenses are going up 4% a year, you're actually getting negative NOI growth, right?
Wait, sorry. Could you say that again?
On the for rent side, when rents are flat and expenses are going up 4% a year,
okay, got it.
You're actually going backwards on NOI.
And the expenses would go up 4% a year. Why?
They just do. They never go down.
Yeah.
Insurance keeps going up. Wages keep going up. Utility costs keep going up. I think we're in a permanent, higher inflationary environment. This whole idea we're going to be 2% inflation after doubling the money supply twice in 10 years. It doesn't make any sense.
I don't see how
we're permanently sitting around 6 to 10%.
No, I think we're going to be in that 3 to 5% range.
Yeah.
I think that's going to be the ultimate consequence of all this, easy money for the last 10 years.
But that's still, we're not going to get to that point probably until 2024 of where inflation comes down to that number that you're referencing.
I think end of this year you'll get there.
Really? Okay.
Yeah, we'll be under 5% this year.
With continued rate hikes.
Well, the rate hikes they're already working their way through the system.
Yeah.
I mean, you're seeing, a pullback in, we track logistics metrics. So we track port volumes. The ports in California are crickets right now compared to there were 90 boats parked offshore a year ago today in Long Beach because there were so many goods trying to get in. They just couldn't, there was a bottleneck there.
So you're saying that's just people aren't buying stuff?
I'm saying that that inventories are really high in the U.S., so there's less stuff coming in to kind of backfill, the inventories because there's less people on the front, on the consumer end buying stuff. So it's both. We have too many goods here that were unsold, and we're selling them less quickly. So that's contributing to also the top line growth of the economy in the last couple of years was largely just inflation driven, right?
Yeah.
And now it's at the point where consumers are nervous, they're buying less stuff, but your costs on the producer and retailer side are going up. Your wage costs keep going up, your operating costs keep going up, your material input, your cost of goods sold keep going up. And maybe you're selling at higher prices, but you're moving less volume. So all that together screams recession. Hopefully it's recession and not, like financial,
ruin,
calamity. Yeah. And I think it's going to end up being somewhat painful, but not, not disastrous.
Did you see the Balaji's bet, his Bitcoin bet?
No.
Going to $1 million. He bet $1 million of his own money. Yeah, never mind.
Unbelievable.
But so this will lead well into where you want to go. How are you assessing deals differently than with this crazy environment that we're talking about? Like, are you adding in different floor constraints?
Yeah, I mean, we've been raising our return. We tweak our assumptions very regularly, but we used to be okay. 10 years ago, we'd be happy building an 8 cap, and it went as low as like maybe a 6.5 cap, and now it's got to be above. It's got to be above a 7. You can argue whether the tax abatement is factored in there or not, and how you treat tax abatement. But when you're borrowing at 7%, you can't be building at 5%, right? On levered return on cost on an income play. So we're also using, higher construction cost estimates and escalations from underwriting to construction start. We're using the forward curve, the forward SOFR curve. We're using lower leverage because things just don't pencil. And just to segue into 1701 market, there's only 3 things that matter really in real estate development if you think about it at a very kind of basic level. It's the cost of land and or the building, the cost of development, the vast majority of which is construction costs, and then there's the rent that you can get on the other side. For a long time, land prices have historically been high in Philadelphia, okay? Construction costs, though, weren't going up 20% per year. They were going up like 5%. And rents were going up faster. So the equation worked. There was an economic equilibrium where you could attract capital into deals, both equity and debt. You could develop profitable projects and you could sell them. Okay, if that was your game, that was your end game. Well, the current situation is land prices are still high, development costs are through the roof, and rents are flat, right? And so that equation doesn't work right now. You know, we walked from a number of deals because you couldn't make it pencil. You know, if the construction costs kind of got in line, then the financing costs shot up, and then couldn't get financing at a reasonable leverage rate. You know, we're generally like 65% borrowers. You can't get 65% leverage on a multifamily deal right now because you end up getting debt service constrained because they're looking at, you know, what's the interest rate going to be in 3 years? They're adding a 1.25% coverage and then a 30-year AM on it. And you end up getting your sizing constraint. And you're in the mortgage business. Sizing constraint ends up not being your leverage rate, ends up being your coverage, you know, at exit or your takeout. So we walked because the deal just didn't pencil financially, which is, you know, it's crazy. And, you know, maybe the deal will come back around. I don't know. You know, we're always working on the deals that we walk away from, just keeping track of them, trying to figure out if the situation changes and something materially improves and we're able to, you know, make that equation solve, you know, we'll take another run at it. But right now, I can't make anything work in Philly. And I've heard the same thing from friends of ours who develop all kinds of other properties all over the country.
I've heard that a lot too, just doing this.
Yeah, we've heard that.
Saying the same thing.
Yeah, the only thing that, and again, this might be out of the space of the scope of what you guys are looking at, is just people saying that, you know, the city might have to come in and, you know, basically offer the land at zero, or, you know, people might have to get more creative somehow. So,
or it's just a little bit of pain until prices come down.
Yeah.
Newsflash: the city is not going to solve this problem.
Yeah.
The economy needs to run its course. The credit cycle, you know, needs to occur. It's a natural thing. Okay. And the only thing that on a local level could help is land prices can go down. But the argument that we've been having with city council for years on affordable housing has sort of hinged around land prices. The argument that people make who are affordable housing and specifically inclusionary zoning, you know, advocates, say, you know, just we'll put these affordability requirements in there and just make the land worth less money. And, you know, these like evil land speculators will just make less. It's a very dangerous game to play.
Yeah.
It takes years for land prices to adjust, right? Not everyone who owns land that could be developed on is an evil land speculator. Some folks have owned the land for a long time and they've been sitting on it this long. They're just going to keep waiting. Right.
Yeah. Right.
So the net effect of you actually decrease housing affordability because you decrease new housing starts.
Yeah.
And that's what's happening. That's what's going to happen after this wave of supply comes online. None of which, by the way,
exact opposite effect of what they're trying to.
Exact opposite effect.
Yeah.
Correct.
Yep. Kind of like rent control.
Yep. But you're going to get both of you're going to get both of those in some form we already have some mandatory inclusionary zoning in Philadelphia. There's a couple of swaths of most of University City is now under 20% affordability at 40% of the zip code AMI.
That's anything above 20 units? Is that
9 units?
Wait, 9?
Anything above 9 units.
Whoa.
From Schuylkill River to, I think, 53rd Street, you know, let's call it from Lancaster Ave down to Baltimore Ave. Yeah.
Wow.
It's really punitive.
Yeah.
And also,
it's tough because build costs are so high at the same time that they're making all of these, you know, so that's, I mean, I guess that goes to why people aren't buying anything. So in this environment that you can't make anything pencil, and this is a question I ask to everyone, how do you manage your short-term cash flow needs that it takes to run a business with this, you know, with the long-term wealth building aspect of real estate? How are you bringing cash in the door today?
So part of the advantage of having a management business is it generates, if you actually do it properly, you can cover a lot of overhead and you can actually generate some profit to sort of subsidize other parts of your business. So that's one thing. The second thing is we are providing increasingly some development services to other out-of-town developers who have projects that they're committed to developing here, and they effectively pay us to be the developer, even though it's their project. We act like their owner, like we're the owner, but they own it.
And essentially take their fees or portions of their fees that they're
correct.
Yeah.
Yep. And that helps keep the lights on. And we are still doing stuff. We're just, we're doing half as much as we used to do, on the kind of new development side, and, trying to find projects where something about the project, whether our ability to build it modular, or acquiring the land at a reasonable basis, or, we're delivering a certain type of unit in a certain submarket that maybe we think there's a demand for based on, our own, kind of eyes and ears on the ground. So we're picking our spots. We're still doing stuff, but we're not as active as we were because we just can't pencil the deals.
So at risk of oversimplifying, you're diverting more of your focus towards service-based business to bring in cash today and only doing deals that pencil.
Correct.
Yeah.
Yep.
Nice. Cool.
One project I wanted to talk about real quick was just your, because I think it's really unique. I believe it's the tallest modular in Philadelphia. Can you just talk about how you guys, there's a lot of people doing modular now. You guys were kind of one of the first in this region. Can you talk about what the decision was to go with that? Maybe what you learned and some different trade-offs there. Is that something you see people doing more of?
Yeah. So modular is not, it's not a panacea. I mean, it's not a one size, fits all solution to construction costs and timelines. We went to modular because we were trying to figure out how to make the equation work. Right?
This is for the LVL that you're talking about. Is that right?
Yeah, we've done 5 of them now.
Yeah.
Oh,
so,
you have done. Okay.
We're doing our 5th one now.
Wow.
And one of them's the tallest in PA, right? Or tallest? Yeah.
Both of them, Level North and both Level. No, I guess it's not Level. Level North is the tallest. It's 85 feet. That's the top of high-rise code.
Nice. So maybe then it would even make sense to focus just on that one. And I would love to hear your thought process as to why Level North was the one that made sense to you guys to do modular.
Well, it was the 3rd of 5.
Okay.
So we'd done 2 before. But cost. We built Level North. It's a 550,000 square foot project. We built it for $110 million. $200 a foot for that building.
Wow.
You couldn't build that. Today it would cost you $300 a foot to build it, full union, full, big contractor.
Wow.
Clemens build it, union contractor, big contractor. They would have cost them $250, $260 a foot to build it were it not for modular. Okay.
Wow.
Just for context, the modules themselves cost $30 million plus or minus, and that is 60% of the gross square footage of the building. Okay.
Mm-hmm.
The rest of the building cost $80 million.
Whoa.
Okay. So that's the delta in terms of
why was it so much cheaper?
you build them in North Carolina, your average
I was going to ask how far it takes to.
North Carolina. Now the factory's moved to upstate PA, but
So including the shipping costs too. I mean, you're still well below what it would cost you here.
well below.
Wow, that's crazy. I didn't realize it was that extreme.
Yeah. Now, the delta has shrunk significantly for a whole host of reasons. A lot of them have to do with supply chains. So it doesn't create the same advantage today that it created 3 or 4 years ago. So we got to find some other, angle. And right now we haven't found that angle.
Now, when you say supply chain, is it getting the, getting the modular here, or is it building the actual modular? Like, what are the main issues with why it's not?
So you're a developer, right? If say you build a 20 unit building, right? It takes you 15 months. You need, the steel early. You need the wood next, but you don't need your plumbing fixtures until you're 2 months from completion.
Yeah, right.
Right. Your fixtures, not your rough ends.
Right.
Okay. That's just an example of what I'm gonna make. When you're building modular, you need every single building component every single day. Because if that line can't kick out finished boxes, your cost skyrockets, and you're going into the yard and you're basically retrofitting stuff when it shows up. So in an assembly line environment, in order for you to get the efficiencies of time and cost savings, you have to have all your materials there every day. Well, and the supply chain makes that impossible, right? You end up, so now the factories are basically building in, buffer because they know they're going to not have everything every single day. They're going to have to go into the yard and inefficiently, install fixtures and countertops and floor, whatever it is, right? And so it just costs more. Transportation costs are also more, right? So that's also adding to your kind of like delivered cost.
So is the assembly line basically like box comes in the front door, gets retrofitted with everything, goes out the back, new box?
Nope. Starts as just materials. So the first station is the chassis, which is basically a bunch of, 2x12, pieces of wood that are cut, and you build like a chassis for a car, but it's a chassis for a box, for a module. And then eventually they put the floor down, they frame out the walls, then they go and they rough in all the utilities, and they put the sheetrock on one side.
Are they doing it per one box at a time, or do they do all of the boxes at once? I guess is what I'm curious of.
Yeah. So there's, let's say there's 15 stations, right? Till they leave finished. Each station, they're doing some logical sequence, building, set of things, right? So it starts as materials and it comes out as a box at the end. It takes about 4 days.
Wow. So like every 4 days, roughly, they're churning out. I mean, I'm sure it's every day. They're
churning out like
box,
3 to 7 boxes a day.
Right.
But it takes about 4 days to get from beginning to end.
I guess my question was, because it just sounds fascinating. Like one box, then at the end of it, the box is done.
Done.
That's wild.
The only thing that's not finished is the hallway. So there's the different ways to configure the boxes, like kind of like Legos. Our typical box has two totally finished apartments with an unfinished hallway. Okay. And all the utilities get run into the hallway, down the hallway ceiling, and up the hallway partition walls. And that's what's done in the field, is the utility connections, and then you actually, you finish the hallway on site. But the apartments are done.
Yeah, in a normal cycle, how
crazy.
long would that take? Obviously, from 1 to 15.
It's like the total development timeline's about, used to be you could save 25% of cost and 25% of time. Now you're saving 5% of cost, and you're still saving time, which when interest carry costs are 8%, not 3%, the time is more valuable.
Yeah.
But the spread is not what it used to be.
Gotcha. So one thing,
It's also harder to finance.
Yeah.
One,
really?
Yeah.
And why is that? Just
Because
banks?
what if the boxes don't show up? What if they show up and they're messed up and they don't fit? There's certain
have you had that happen to you? Something like
we
that,
haven't,
where,
but
one box is messed up.
every lender has a nightmare modular story. None of them have great modular stories, except for the ones that we've developed.
Interesting.
But yeah, there's not that many lenders that will finance true like large scale multifamily or housing built modular. It creates a whole level of risk that they can't wrap their minds around it.
Yeah. Interesting.
So one thing I wanted to bring up, I don't know if this fits kind of in with the modular, but NHB came out with this survey nationwide that said 45% of all home buyers stated that one thing that they would concede on, or renters, is square footage. Is that something you would factor in, or is that something you factored into this project, or is that something you would look at going forward as maybe smaller units as a way to kind of help compensate with the market right now?
Josh, we are categorically the pioneers of small apartments in Philadelphia. We built the smallest units out there, and now we're building them a little bit bigger because people want a little bit more room. So
When you say small, is it mainly the kitchen living?
everything. I mean, we've got
Even the bedrooms and
we got a building at it's adaptive reuse project called One City at Broad and Arch, and that building has 323 apartments in it. The average square footage is 450 square feet.
for
got
one beds or
100
studios?
Well, that's across the entire
Yeah, gotcha.
unit mix, but we've got 180 studios that are on an average 380 square feet, and we have them as small as 320 square feet.
That was one of the reasons why I wanted to ask you these questions.
That's this room,
Yeah, wow.
right?
But there's demand for that.
I'm assuming they
This room's a little
probably
bigger, actually.
rent super efficiently, right?
do.
Yeah.
I mean, in terms of like rent per square foot.
They do rent efficiently. They didn't rent that well in COVID because people wanted more
Right.
space. And
Right.
Do you have high turnover?
Across the industry, smaller the unit, the higher the turnover.
Oh, okay.
Interesting.
But
So would you do something like that in the future? Or are you, like you said, trying to do more square footage for kind of rentals going
would
forward?
we build micro units?
Yeah.
I mean, we just did. So yeah.
Yeah.
I just think that we're building less of them, and we're building more units that have more square footage.
Gotcha.
All right, I think we're going to wrap up in the next few minutes. So we have a couple questions we'd like to ask everyone.
Sure.
Firstly, I'm just curious, what is, in your opinion, your best deal that you guys have ever done? What's your worst deal you've ever done?
Best deal and worst deal. I'll make it local. Probably our best deal was we redeveloped 1616 Walnut into the Icon. We did that about 10 years ago. When we built it, it was the first kind of true luxury apartment building in Philadelphia. Of the modern generation, even though it was in an old building. And I think what we did there was a really good adaptive reuse execution. new windows that were historically the same, profile. And we turned John Pugh's pied-à-terre into a amenity space club room. And we kind of rebuilt a beautiful roof deck and all kinds of amenities still do in the building. There's a parking garage in the building. It's just the first integral garage built in Philadelphia. So it had that, the building gave us that already. So that was the best we ever did. The worst deal we ever did was we stepped into a partnership that had bought the old Northeast Hospital from Temple Health System. Mm-hmm. And that was a spectacular failure. We really, we were brought in and then we were taken out, not profitably. And we really didn't fully appreciate how specialized healthcare real estate is and how little we knew about it. So, that was about 10 years ago as well.
So what do you think is the biggest thing you learned from that deal?
Funny. I remember vividly telling my wife that the deal had no risk. I remember her looking at me and being like, everything has risk. You just don't know what it is yet.
Yeah.
And she was absolutely right. So the
woman's intuition.
Yeah.
Well, my wife also went to Harvard and MIT. She's pretty darn smart. In addition to women's intuition.
Okay.
You should bring her on.
She's
Fair enough.
She's had a lot of I told you so's in the past, 19 years of knowing me and 15, 16 years of marriage. When you can't identify what the risk is in something, you should be really scared. So we try to, whenever we're making an investment, list all the things that could go wrong and what control we have or don't have over those things and what the impact of those things would be on the investment's outcome. So if you look at things, okay, so what can go wrong here if you spend a lot of time on that? Chances are you'll get a good list of what can go wrong, and then maybe you'll find something in there that's enough of a showstopper you don't buy the deal. You make more money in this business in the stuff you don't do than in the stuff that you do, because you save yourself financial loss, lots of time sunk into trying to salvage something and a lot of anxiety along the way.
It's funny. Sam Zell actually said that too. He said the best deal he ever bought was the one he didn't buy.
I'm glad he said that. I think Sam Zell's got a lot of good quotes. Sam actually taught a class to a small group of students at University of Michigan when I was there. He came 10 times on his private plane through Ann Arbor. It was called Risk and Reward. And every couple of weeks when he came in, there was a different, Sam Zell situation or deal. So, and he was very open about some deals he lost a lot of money on and kind of what he missed and why he did it. And it was fun. So I've had a lot of.
So you know Sam then?
No, I mean, he was, I saw him 10 times, 25 years ago.
I find him to be like the most fascinating person in the world.
All right, imagine the guy shows up, you're 19 years old, 20 years old, and he shows up wearing a knit Tasmanian devil sweater. And the guy looks like the Tasmanian devil. He's like the human incarnation of the Tasmanian devil. I was like, oh my God, this is amazing.
Did you know you were getting into real estate at that point? Like,
no, I got into real estate, years later.
Yeah.
And actually, most of what he talked about wasn't real estate.
Really?
He was doing an oil pipeline in Kazakhstan. He was buying the Tribune. Like, he was doing all kinds of.
Do you have any like fun like stories or anecdotes from anything that he taught you?
Yeah, I think his entire investment in Kazakhstan just got taken by the government.
Wow.
Just
nationalized? It was
I think so.
Whoa.
I think maybe it was sort of happening while we were doing that.
Oh my gosh.
Yeah.
I wonder how you even manage the stress that comes with a deal like that. Like I have my $1 million deal that's like shaky and I'm like freaking out.
He lost his shirt on the Tribune. I mean, he lost hundreds of millions of dollars on that deal. So Sam's made billions of dollars, but he's been very vocal about the stuff that has gone.
It's one of the reasons why I like him. I like listening to that.
Yeah.
He's got a lot. He's also like just unfiltered.
Yeah.
Like, which I gravitate to unfiltered.
Yeah.
Yeah, seriously.
Awesome.
All right, last question here. If your entire network and all of your assets were taken from you, how would you restart today in Philly? Ooh. Or just restart in general?
I've been trying to do a lot over the last 20 years to make sure that outcome never comes into play. How would I restart?
No network, no assets, but you can know what you know now.
That's a tough one. I think I would definitely go back into real estate. Mm-hmm. I would probably go get a job with a company that needed someone that was trying to get into Philadelphia. I needed someone who had kind of deep local knowledge, of the market, even if maybe no capital and no relationships anymore.
Yeah.
Because there's more than just relationship. Like the local landscape is more than just the people that it's understanding the zoning code, which I understand very well. It's understanding the municipal planning process. It's understanding who the employers are, what the job drivers are, what kind of tenants there are, and where they are in the city and where they want to be. I still know a lot of that really. Like as much as I'm not day to day, every day working on developing apartments and mixed use properties in Philadelphia, I still have a very good feel for the market.
Mm-hmm.
So that's probably what I would do.
Cool.
And by the way, in 2008, I almost did that. So
there you go.
So it's real.
Yeah.
Well, hey, I really appreciate it.
This was an awesome conversation.
Thanks so
Leo.
much. Yeah,
all right,
thanks.
thank you both. It's a great project.
Thanks.
Awesome.